It has been a sparkling Samvat 2077 for the Indian equity markets. While the S&P BSE Sensex has surged 37% during this period, its NSE counterpart, the Nifty 50, moved up 39.5%. Gains were broad-based. The mid and small cap stocks caught investors' fancy, with the two indices on the BSE moving up 61.5% and 81% respectively in Samvat 2077. The rally for the frontline indices this Samvat was the best in 12 years. Back in Samvat 2065, the Sensex and Nifty had risen 104% each. The mid-cap index had gained 123% and small-cap had surged 120%. Gains in equity markets in Samvat 2077 far exceeded returns from other asset classes like gold and fixed deposit, and also the savings bank rate. Among sectors, realty gained the most at 122% in Samvat 2077. The other prominent gainers included the Nifty Metal Index and Nifty PSU Bank Index. On the other hand, pharma, FMCG, and private banks were underperformers as defensives took a breather. This liquidity-driven rally saw foreign portfolio investors pump in around 1.36 trillion rupees in Indian equities on a net basis during Samvat 2077. Domestic institutional investors, including domestic mutual funds, insurance companies, banks, financial institutions, pension funds, etc., on the other hand, withdrew nearly 36,682 crore rupees after 5 consecutive years of inflows. Going into Samvat 2078, experts suggest that investors brace for volatility. The market direction, they say, will be guided by a host of domestic and foreign factors that will keep the markets choppy. These include commodity prices and their impact on inflation and corporate earnings, policy stance of global central banks, especially the US Fed, fresh wave of COVID infections, if any, global developments like economic recovery and China factors, and IPO pipeline besides liquidity with retail investors.
Economy is actually on the growth path, on the revival path. Whatever economic indicators that you see, whether it is export, whether it is GST collection, whether it is balance of payments, fiscal deficit, all that looks reasonably all right. I think there has been a very sustained recovery from the gloom and doom that we saw last year. So that's a big positive. And also, if you see the quarterly results, September quarter results have been almost uniformly good, especially the public sector banks and all that have started recovering from the huge mess they were in. So I think generally, if you see, and the biggest, I think, beneficiary of all this is that the economic activity shifting from the informal sector to the formal sector. That is one of the reasons why you are having this GST increase and all that. Because the informal sector is the one that has been affected badly by COVID and all that. And during the COVID restrictions, and people started shifting to sort of digital transaction, digital payments. So therefore, I think all have been drawn to the formal sector. And so that is why you see that the listed companies are doing very well, because they have got additional business from what was otherwise being done by the informal sector, not paying taxes and stuff like that.
Okay.
So these are the positives for the Indian market. But the argument could always be that all this and more has been factored into prices. Prices are at all-time highs or near all-time highs. And if you really see, the prices have started going up once there was a reasonable level of sort of confidence on FY22 results. But unfortunately, what the market is doing is FY22 results are being compared with FY21 results, which I think is the wrong way to go about it. FY21 was a disaster. So therefore, if you really compare FY22 with FY20, then I think we have just come back, because from FY20 to FY22, there should have been 2 years of growth. You're not finding 2 years of growth. You're finding a very good growth, but it is not 2 years growth. So which means that our benchmark is so low, which is the FY21 numbers. Everything looks optically very, very positive. It is not so, and this is what has probably driven the market. Now, the other point is that The foreign portfolio investors are very important participants in the market, but they are consistent sellers for the last more than 4 weeks, and almost all-time high is selling. So therefore, one needs to be worried because finally the market is being propped up by retail investors, whether directly as retail investors or through mutual funds. Now, this is all, in fact, the bulk of retail investors have probably never seen a bear market. What will happen when markets correct is something that we should really be worried about.
Against this backdrop, investors should brace for a volatile phase in the Indian equity market in the short to medium term. Moreover, FPI trends amid a likely deferral of the T+1 settlement cycle will also sway market trajectory in the near term. According to a Business Standard report, the Securities and Exchange Board of India is likely to defer and tweak the diktat on implementing the T+1 settlement cycle. Following representations from foreign investors, the settlement cycle may now be implemented in a phased manner starting February 25 and apply only to the bottom 100 companies. That said, the markets will remain closed today on account of Diwali. However, the exchanges will hold a special Muhurat trading session in the evening to usher in Samvat 2078. This year, the Muhurat trading session will begin at 6:15 p.m. and end at 7:15 p.m. and the closing session is slated between 7:25 and 7:35 p.m. Markets will also be closed on Friday on account of Diwali Bali Pratipada.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.